Good morning, welcome, and thank you for joining us for this portfolio update on the Amati AIM IHT portfolio service. I'm Colin Thompson, one of the sales team at Amati, and updating you from the fund management team today, we have Macdonald and Scott McKenzie, who will be joined by David Stevenson for the Q&A session at the end. This presentation is very much a portfolio update. There are many different solutions for transferring wealth efficiently between generations, and as an AIM portfolio service is only one of a range of possible solutions. We only accept investments for the service where suitability has been assessed by an authorised professional advisor. Just a couple of points on the format of the presentation today. Anna will give you an overview of the portfolio, covering sector split, market cap weightings, and the stocks that have contributed both negatively and positively to performance. Scott will then take over, looking at equity valuations in general and where the AIM market sits in comparison. He'll talk about the characteristics of the stocks we seek to hold in the portfolio and cover recent portfolio activity, finishing up with an outlook. As always, there's a facility on the webinar page to submit questions to the managers, and we'll address those at the end of the presentation. With that, I'll hand over to Anna.
Good morning, everyone, and it's a pleasure to be here. This is a slide illustrating our investment team. As you know, Scott's on the call. You may not have come across him before. He is the newest member to join the team. He joined about a year ago, and he has really helped us broaden our and deepen all our coverage of different sectors, and has taken on some of the sector coverage from David and Paul and I in particular, which has been extremely helpful, and he brings a wealth of experience in the industry. And so he's a fund manager, and we all work on all the funds. So we all work together on the IHT portfolio service, the smaller companies fund, and the VCT. So it really gives us a good cross fertilization of ideas and sectors, and Scott's fitted in extremely well. The summary of the portfolio service is at the AIM IHT service. It's just shy of 50 million under management as at the end of 31st of March. We have 27 holdings with a median market cap of around 400 million. The total AUM in the UK smaller companies products that we run, which I just mentioned, the VCT, Smaller Companies Fund, and IHT portfolio services, is just over 1.2 billion. This is a breakdown of the market capitalizations that we have in the IHT portfolio service. So you can see we've got quite a substantial amount in the more liquid stocks of maybe 500 million to 1 billion and 1 billion and over, and this enables us to have a good to access good liquid names, whilst some of our smaller company holdings helps us find those smaller opportunities which we hope will grow successfully in the future. The sector weightings have changed quite a bit. This is comparing last March, the end of last March 21 with now, and you can see that we have changed the weightings quite a lot. Healthcare has increased, probably most notably, whilst we have reduced our consumer discretionary weightings. I think that's probably quite mindful, I suppose, of the squeeze to consumers and difficult supply chains that we're seeing affecting consumers' discretionary names in particular. And healthcare, we feel that there are perhaps more robust revenue streams going into healthcare stocks. It's also quite a diverse sector in itself, really. It's very different from the kind of healthcare stocks that we would own in the VCT, which would be more biotech, slightly riskier names. These are quite substantial names, and actually one of them has recently received a bid, so has done very well for the portfolio. That stock is called CareTech. The performance has been difficult, particularly over the last 6 months, and we have underperformed the benchmark by nearly 5%. And whilst the longer term record remains intact on the 1 year and 3 year and since launch, we have had, and also maybe it should be mentioned that we are actually finding that our underperformance has for the moment it seems to have stopped, and we have and definitely performance seems to have stabilized. We will the last 6 months were difficult, and we're going to talk you through what's driven that and what we've been doing about it. And the first thing we're going to do is cover off the main detractors from performance so that you can understand where we've been hit. These are the 1 year negatives for the portfolio. You can see here we've got eco animal health. That's that's been a significant negative contributor. Now it had a very strong 2020 as they had excellent sales in China as the pork and poultry producers, particularly the pork producers, recovered from a very tough 2019. And that tough 2019 was driven by African swine flu that hit pork prices substantially. And now, unfortunately, there have been further waves which have further hit pork prices and constraining demand for their products. We have now sold this position. Gear for Music has also, after a very strong 2020, as there was a lot of, as COVID led to robust sales of musical equipment and instruments to people's homes, it's underperformed. It's not only facing quite tough comparatives, but they've had issues in building up some. They were investing in distribution centers in Europe, and there have been some delays there. And this is the best way that they have to counteract the delays caused by Brexit. So that has the shorter term issues there with getting those operations up and running have led to reduced profit expectations. We still like the company and we really rate the management. Morse's Club fell sharply after a profit warning, and that came around from increased activity by claims management companies, encouraging customer compensation claims, and also the surprise departure of the CEO. So this has caused quite a lot of uncertainty. Frontier Developments was another lockdown winner. It's a video gaming company, and the video games sold extremely well during the initial stages of the pandemic. They've actually, the video games market remains quite robust. However, for Frontier Developments, what they found was that sales of their second iteration of their Jurassic World Evolution game were weaker than expected. There were also a couple of production delays in other games and some glitches. So that has led to some pretty sharp downgrades. It's a very operationally geared company. And we have now sold that from the IHT portfolio service. Craneware, we took shares in placing to finance a deal that we really liked. However, the shares did fall in the broader tech sell-off that we've seen across the markets, which really started in about the end of third quarter, beginning of the fourth quarter last year. That was driven by tech names really being more expensively rated, and they, as people worried about inflation and then consequent interest rate rises, that increases the discount rate, which is applied to a lot of these longer term revenue and profit generating technology names. So this affected Craneware as it affected many other companies in the sector. We have added actually to Craneware on weakness because you could think that the company has made a really good acquisition and is going to generate significant earnings and earnings upgrades going forwards. The positive contributors for the portfolios have been the two top ones have benefited from bids. So Sumo is another video gaming company, but unlike Frontier, did video game services, and it was very strong during the pandemic, and then received a bid approach from Tencent at a pretty significant premium. That's now exited the market, and CareTech has actually just received a counter bid from management. So management announced an intention to take the company private. A counter bid then announced, and then only yesterday, management upped their bid to 750 pence. Traxys, we had actually a very reassuring meeting with management yesterday. It's a company that provides rail and ticketing software applications, and it's done extremely well. It's a buy and build story where they've really integrated the different acquisitions well. They also have an events business where they do, for example, manage the traffic around Glastonbury, for example. And so as that kind of business has returned after the pandemic, it has done well. And other two companies on here, YouGov and Restore, have both been performing very well for the IHT services. So how do we think about our portfolio? This is to remind you of the different baskets we look at. So we think these all we think this approach helps us find long-term ideas for total shareholder return to benefit the IHT portfolio service holders. So on the top left, you can see family. That's often where we, and I can actually toggle into the next slide to give you an example. That might be something like Young's Breweries. It's a pub, hotel, and brewery chain. It's been around since 1831, so has very long-term family ownership and a very established brand. It has a well-underpinned dividend as well, which has returned since the pandemic. Owner managed is the bulk of the biggest basket in the portfolio. It's 42%. And to give you a couple of examples, we have Inspecs here, which is a vertically integrated designer and distributor of eyewear. Robin Totteman founded the company about 30 years ago, and he still owns just shy of 20% of the equity. Cakebox is another founder managed company, and it has actually had a bit of a torrid first quarter, but has started to recover, and the CEO is a significant shareholder. Established technology makes up 17% of the portfolio. We like to think of these as kind of mission critical companies that are profitable, cash generative, and have a clear USB and barriers to entry. And as you'd have seen on this slide, that includes companies such as Traxys and Gamma. Finally, we look at durable defensive names. That's around a quarter of the weighting. Now, these companies have an attractive yield, and we like to think that they are not particularly cyclical, and so they will deliver robust earnings over the cycle and have a well-covered dividend and defensive qualities. So That might be animal care, which provides medicines to vet practices, and also Restore, which is a records management company. So let me hand over to Scott now, who's going to take you through some of the valuations and the themes that we're seeing, and how we've been changing and adapting the portfolio to the current environment.
Thank you, Anna. Yes, the next couple of slides really we'll look at some of the themes that we're currently identifying within the smaller company world, what these themes mean for the portfolio, and just some of the changes that we've made in response to the changes in the market. The slide here looks at a very simple analysis of PE ratios across the market cap range. This is across all UK equities from large to small and including AIM. And the chart on here really just attempts to look at how the PE ratios of the various size caps have actually leveled out quite considerably, particularly in the past 6 months. Had we looked at this chart about a year ago, the AIM and small cap part would have been considerably higher in terms of the valuation, and the large companies, predominantly the FTSE 100, would have been considerably lower. So we've seen quite a reversal in that trend, particularly in the last 6 months, as the FTSE 100 has begun to catch up with the rest of the UK market, and the small part and the AIM part have kind of given up, some of their previously very strong gains. So there has been what we would describe as a leveling up in valuations, and we hope that signals perhaps better times ahead for the small and AIM part of the service that we provide at Amati. The FTSE 100 has very much benefited from some of the recent tragic events in Ukraine as well, particularly in sectors such as oil and mining, which tend to be less well represented amongst the smaller parts of the market. So definitely a major change in valuations in the last 6 months, with small and AIM somewhat lagging. When we look at some of the style factors affecting markets, again, we're using the same Liberum MSCI data as the previous slide. It's a very simple analysis. It takes the UK small cap index and splits it into two camps, growth and value. So a relatively crude kind of measure, but nevertheless, it gives us the trend that we're observing. And what we've done with the chart here is take it back over 3 years to the beginning of 2019. So it captures all of the COVID fluctuations in the market, as well as the more recent inflationary and Ukraine impacts that we've all seen in recent months. And really, what we've observed is essentially a round trip, with growth factors performing very, very strongly during 2020, particularly in the aftermath of the initial COVID pandemic. And we saw very, very strong performance from sectors such as technology and healthcare in particular during 2020. And we saw a very significant outperformance of growth up until really the end of 2020, when the vaccine program started to be rolled out. And we can see at the end of 2020 that basically started to roll over, and value factors started to come back into consideration again. And really, from the end of 2020, we've seen a recovery in value factors in the small cap universe. And that's certainly provided a headwind to IHT portfolios, which typically have a growth bias in the companies that we're looking for. And really, that's been quite a change in market sentiment, and a very volatile pattern over the 3-year period. So as we sit here today, we're not really making any strong proclamations one way or the other. We think it's become, again, quite a level playing field. We don't think one style will predominate in 2022. But what we do think will happen is that quality companies will begin to catch up again. And if we move on to the next slide, we've got some analysis of quality factors. This is a database that we've been using for a number of years, provided by Canaccord Quest. It's been around for over 25 years now. And what Quest does, it analyzes both companies and portfolios for us. And it looks at some key factors such as value, momentum, and quality. What we've done here is asked them to look at the performance of quality factors for the UK small cap universe. It's a universe which is defined by Quest, so it's not identical with our own Numis AIM benchmark, but nevertheless, it's a reasonably solid proxy for what we're doing in the AIM IHT service. And over the years, quality has been an enduring feature in success in smaller companies, and that's shown by the red line on the chart. So this is the cumulative effect over 20 years of the top 20%, the top quintile of highest quality companies, how have they contributed to performance against that universe. The brown bars are effectively quarterly returns for the quality strategy, and you can see that those have had some volatility over time. But when we do it on a cumulative basis, the red line tells the story that investing in high quality small companies over the long run tends to be a winning strategy. And that's what we're really attempting to do in the AIM IHT portfolio. And the next slide just expands on some of those Quest factors that I made reference to a moment ago. So the Quest database assesses every single company in the database for those factors of quality, value, and momentum. And we're looking really here on this slide at the quality factors. And these are companies that we've been either buying and adding to the portfolio or increasing our exposure to. Anna made reference earlier to the increased weighting in healthcare, and the two new holdings that we've put into the service in the past 6 months both fit into that category. Both Craneware and Emis Group are involved in healthcare software. So they're very much at the solid established end of the healthcare spectrum. Anna's made reference to Craneware already. We did obviously get involved in the placing towards the end of last year. The shares have come back a fair bit, and we've since added to the holdings in the service, taking advantage of what we believe is a very depressed share price there. Emis is a new holding in the current year, and that is also involved in software, again, predominantly with the NHS, as opposed to Craneware, which is predominantly in the US. So two relatively similar type themes that we are playing there. And what all of the companies on the page have in common is very high quality ratings. And the Quest system assesses quality, looking basically at things such as return on capital, balance sheet strength, and durability of margins, etc. Basically, the return on cash over the cost of capital. So all of the companies that we've been adding to in the service over the past 6 months all have very high quality rankings, as shown by the quality numbers in the red. They also have what we consider to be very positive risk attributions. Again, the Quest service has a risk rating looking at accounting quality and exceptional items and financial risk, with 100 being a very positive score and 0 being a very negative score. So again, the companies that we're adding to for the service are all fit that criteria of being very high quality with acceptable risk ratings too. The final three in the slide, Brooks Macdonald will probably be familiar to many people on the call. A wealth management business which we think has got quite exciting prospects, and particularly in the light of the recent takeover for Brewin Dolphin, we think there's considerable upside for Brooks Macdonald shareholders. Similar kind of valuations could be applied. Gately and K3 Capital are both business service companies. Gately is legal services, and it's been a very consistent performer since its IPO 7 years ago. K3 Capital is a more recent company. It's come into the portfolio in the past year, but again, benefiting from taxation and insolvency, which we think will be very growing services. All the companies that we've been adding to have good dividend prospects as well, which is an important part of what we're doing in the service. All have high and growing dividends. In terms of the companies that have left the AIM IHT portfolio recently, there has been a bit more activity than there would be normally. And I think the reason for that really has been that we are facing different market circumstances. Certainly, as we went through Q4 of last year, we're now faced with rising interest rates, significantly higher inflation, and much more focus on valuation. We've seen fairly momentous declines in the Nasdaq from its peak, and we've seen a similar fallout in the AIM and small cap markets here in the UK. And one of the things that the team was looking at towards the end of last year was we had to be careful with valuation. A number of companies had done very well for us over a number of years, and it was clear to us that some of those valuations could get challenged in the months ahead. So the 5 companies that we've disposed of, with the exception of Eco Animal Health, which Anna alluded to earlier, the other 4 companies all had very stretched valuations. All were good companies and had broadly served us well, but we took the view that valuation become a much more important part of people's assessments of the market going forward. So those are 5 examples of companies which have left the portfolio over the past year. Anna has already covered Frontier and Eco, as I say, Focusrite and AB, good companies, but we felt they were far too expensive for the market environment. So just one final slide from me in terms of where the UK market fits. This is a broad measure of the UK market, including large, medium, and small. And what we've done, we've worked with Liberum again, who produce significant amounts of quality data on the markets, and they've adjusted the sector kind of biases within the major markets in the UK, US, and Europe. As most people will be aware, the UK has a very low weighting to technology in aggregate. The FTSE 100 in particular has virtually no technology. It tends to have a number of highly mature sectors, highly mature companies in sectors such as oil and gas, mining, banking, tobacco, etc. So what this analysis does, it tries to take account of the big sector differences between the US and the UK and Europe and try and neutralise them. And the analysis that Liberum have done for us concludes that even when we make those adjustments, the UK remains, one of the cheapest world markets, even accounting for the sector differences. So we hope that gives us some comfort, in what are relatively challenging times at the moment. We do believe that there is, still a lot of value to be found in UK stocks in general. So really, just to summarise the presentation, the AIM market, there's no doubt that it has suffered in the past 6 to 12 months. We've seen valuations come down fairly significantly, and that has impacted the portfolio for our AIM IHT service. We believe that is beginning to level out now. And there's been a change in emphasis. There was very large premiums being paid for high growth and small cap exposure. That premium has begun to unwind. So we do believe we're on a much firmer foundation in terms of small cap and AIM valuations than we were 6 months ago. The portfolio quality focus is always going to be on quality companies with decent growth prospects. That remains the case. That has been the case for many years. That focus hasn't worked in the past 6 months, but we do believe that keeping that focus is absolutely crucial to rebuild returns and get the portfolio moving in the right direction again. So no change really in what we're doing at Amati, and if anything, we're doubling down really on the quality aspects of what we do. And the final point, as I just mentioned, the UK market, we believe, is still a very attractive market. And I made reference to a couple of bids in the portfolio that we've seen already. CareTech is one which is very live, and we have another business, Randall and Quilter, in the insurance sector, which is in talks regarding a takeover as well. So we are now seeing real examples of M&A activity amongst UK companies. So with that, I'm going to pass back to Colin, who will moderate any questions that we have. Thank you.
Thanks very much, Scott. We have a few questions. A couple I can take before handing over to the ones that are addressed to the managers. First of all, how many individual investors are there in the portfolio? Well, we have 350 investors in the portfolio service. And the other one was, can one buy into the fund as an asset in an existing ISA? And no, you can't, due to the fact that it's not a fund. The AIM stocks have to be held in your own name to work for inheritance tax purposes. But you could transfer part of an ISA into the service. With that, I'll move on to some of the questions that have come in addressed to the managers. Firstly, Scott, you talked a lot about quality, and we have a question on what are your markers of quality. So I wonder if you could expand on some of the metrics.
Yes, absolutely. Yeah, I made reference, to the Quest database, which gives us some good guidance on this. Two of the key things that we really look for in the companies are we want to have companies that have got very strong balance sheets. And we think that's really important, particularly in the more challenging economic times. We could be facing much slower economic growth. We have very, very high inflation at the moment, and rising interest rates. and therefore where we don't want to be is in companies with lots of debt. And across the portfolio, the vast majority of our companies have got very strong balance sheets, in some cases, considerable net cash. The other thing we look at a lot in terms of defining quality is the profit margins within the businesses that we own. And again, we really want to be backing businesses which have got strong and defensible profit margins. That's again going to be very important in the current environment. We've got a situation where inflation is endemic across all sectors, and passing on inflation is really a key question for all the companies that we meet at the moment. And not all businesses will be able to successfully cope with inflation. We believe that companies with really high profit margins are far better placed than companies with really low profit margins. They typically are asset light and have intellectual property or very strong market positions. So those are two of the examples of the kind of quality factors that we're looking for. I guess the third major one would be a return on capital, which is well above the cost of capital, so that the companies can continue to make investments and compound the returns for shareholders. So those would be some of the key examples that we would be looking for.
That's fantastic. Thanks very much, Scott. We have a question on recent performance, and is that linked to the high turnover of the portfolio service? So I wonder, David, could you comment on the turnover and how that links up to recent performance?
Yeah, Colin. Good morning, everyone. I think it's important to stress that, yes, we have had some recent higher activity, both buying and selling. And the bulk of that, as Scott has already said, has been a reaction to the major market shifts that have been taking place, certainly the last 6 months and arguably a bit longer, and in particular, the repricing of growth that is happening, not just within the AIM market, but across all global equity markets. And that repricing and the risk attached to that continuing has been the primary driver for the selling activity that we've had. Now, it's in the nature of the portfolio service that one side of the buy and sell equation drives the other, because overall we have to maintain a virtually fully invested portfolio to provide the appropriate tax relief. So over a period where we have been selling activity has been a bit higher to protect the portfolio, that necessarily requires buying on the other side. So both those things are reflective of one decision, if you like. We also have had an overlay of company specifics, which have driven some of that decision making. So we've had issues with Eco Animal, we've had bids for Sumo, and currently Randall and Coulter and CareTech. So that prompts a degree of underlying turnover in the holdings as well. Our objective here is to provide a portfolio of long duration quality stocks for which we don't need to churn the portfolio. That is our objective. So I think you should view the more recent increase in activity as a sort of lumpiness and a shakeout, not representative of what we do overall. Our smaller companies fund, which is significantly invested in AIM as well, has a longer term turnover ratio of 25 to 30%. So we're holding companies for 3 or 4 years. Our objective with the service is to actually hold companies, if possible, for longer than that. That hasn't been the case more recently, though.
Great stuff. Thank you very much for that, David. Anna, I have a question on markets in general. So markets still seem nervous and volatile. Are stocks likely to underperform until there's an end to the Ukraine war?
I think aside from the fact there's obviously a completely awful human tragedy that is happening there, I think that the war has highlighted the very vulnerable nature of some of the Western economies, particularly in Europe, given how exposed we are to energy prices in the markets, given how much is of Russia's natural gas that we consume, particularly in Europe. And also we know that wheat and rye and rapeseed are all important soft commodities that are harvested in abundance in Ukraine and Russia, and these are all increasing in price because we're not quite sure. I mean, harvesting, as you can imagine, we don't want to buy things from Russia, and harvesting anything in Ukraine, planting and harvesting anything in Ukraine is obviously tremendously difficult. So all these impacts are only going to exacerbate the inflationary environment that we're seeing, and further snarl up supply chains. And we've also got continued lockdowns in China, which is another big issue for us to deal with. So it's fair to say that the recovery we saw from the pandemic has really really been threatened, I suppose. There are still, however, positives to think about, and whilst we do see inflation rises and we see interest rates as going up, interest rates do actually still look quite low, and there is, whilst governments are indebted, they are currently able to service their debt. So there are areas I would say that the path of investment opportunities seems narrower than ever did, but we do see that there are some opportunities. We see that there are still some robust names that we can invest in, and we've tried to reflect that in the portfolio that we've got. The war doesn't seem likely to end anytime soon, although it does seem to be entering a new critical phase. And so I don't think we want to say that suddenly everything will be fine when the war is over, because when the war is over, it will all look like a very different place. I think Europe already, there's been huge tectonic shifts. We've seen that even with yesterday's announcements that Finland and Sweden are going to join NATO. It seems that 30 years of peace has kind of come to a pretty abrupt end. So we need to concentrate on the individual portfolio constituents that we're looking at and how robust each of them is, and whilst paying attention to what we see in terms of the global environment. But yes, there's a lot to think about.
Brilliant. Thank you very much for that, Anna. We have two questions on the same vein. Can any AIM stock be included in the portfolio? Are all AIM shares IHT free? So I wonder if I can hand that one to David.
Yes. The second question as well is about the connection between AIM quoted shares and IHT exemption. The history of IHT exemption with AIM shares is linked to business property relief, and in fact, inheritance tax relief originally was set up for family-owned, principally farming businesses to protect subsequent generations who wouldn't have to sell the farm to deal with the old death duties. And so IHT exemption was applied to that through a mechanism called business property relief. AIM shares are, from a tax point of view, defined as unquoted. And from that standpoint, they qualify for business property relief and hence the IHT exemption. But within that, yes, there are certain areas, certain of business activity that do not qualify for IHT exemption. Those are fairly detailed and complicated, but broadly, companies that have a significant proportion of their business activities involving transactions in property or shares or forms of asset management are specifically excluded, as are broadly resources, although we do have had one position in the portfolio which qualifies. So broadly those areas are excluded, and that drives clearly the portfolio composition. We use a third-party advisor who will look at all the positions we want to put in the portfolio and does an annual audit of the entire portfolio to make sure that we are still keeping within the qualifications and the guidelines. That's Philip Hare Associates, who's an expert advisor on all things venture capital trust and AIM IHT.
Fantastic. Thank you very much for that, David. We've got a question on the fees for the service. Our investment management fee is 1% plus VAT on the portfolio value. There's also a custodian charge, which is for administration and custody, and that is 0.3% on the portfolio value. And finally, an annual £35 nominee fee. All the details on the charges can be found on our website, amatiglobal.com. Another question for the managers: have you encountered any liquidity concerns when looking to sell holdings?
Maybe I'll take that one, Colin. Yeah, I mean, the nature of AIM is such that it can be feast and famine at times. Thankfully, the service, AUM at 50 million is a manageable size. So therefore, we don't tend to encounter significant issues when dealing within the portfolio. If I take the recent sales that I highlighted on the chart earlier, perhaps only one or two of those were done over a couple of days. Generally speaking, we can get same-day liquidity for the vast majority of the holdings in the service. So we haven't experienced any specific issues, but it's definitely been more difficult perhaps in the last 3 to 6 months that had been prior to that. But let's not forget, AIM is a much deeper and more liquid market than it was, say, 10 years ago. There's a far larger number of companies on AIM now, and the quality of the companies has improved dramatically over that period. So it's something that we're mindful of, but as of yet, we haven't had any major liquidity concerns in the IHT service.
One thing I might add to what Scott's just said is that the one the one advantage of quality growth, sustainable growth companies is they create their own liquidity through time as more and more investors become aware of the story and interested in investing in these sorts of companies. And a point I should have made earlier when answering the question about portfolio turnover activity is that a number of the names that we've been selling in the last 6 months are companies which have been contributors factors in our longer term outperformance. So some of those names like Frontier and others have been very significant contributors to the portfolio performance, and the liquidity with stocks like that have improved over the years, and so that also helps in what is undoubtedly a more tricky market for liquidity.
That's fantastic. Thank you very much for that, David. Just to clarify on something mentioned earlier, the portfolio service can be held within an ISA or a general account, but as it's not a fund, you couldn't hold it as a link within somebody else's ISA. So that's the definition. The individual can still hold the shares in their own name, but within an ISA, within an ISA structure. So that still works. I think that's probably it for the questions that have come through so far. But if any others have been held up and come through subsequently, we will get back to you individually. So thanks to Anna, Scott and David for the presentation and for answering the questions. And thank you very much for submitting the questions. It made it far more interesting for everybody concerned when there's that many questions. If any other queries come to mind, please don't hesitate to contact your sales contact, as shown on the screen here. It'd be great to hear from you. And until the next Amati presentation, goodbye for now.